When you refinance your mortgage, you replace your existing home loan with a new one for the same property. There are many reasons to refinance your home loan, from locking in a lower mortgage interest rate to tapping into your equity. Understanding the process can help you prepare and save money along the way. Dig deeper. Is now a good time to refinance your mortgage? When you refinance your mortgage, you're essentially paying off your current mortgage with a brand new loan. And while the process might seem daunting, it's helpful to know what to expect beforehand. To help you navigate this journey, here's a step-by-step guide to refinancing your mortgage. Step 1. Prepare your finances. First things first, make sure you're financially ready to refinance. Check your credit score and see if there are ways to improve it before refinancing. Your credit score plays a big role in your ability to get approved and will influence your interest rate. The higher your credit score is, the lower your interest rate will likely be. It may be worthwhile to wait to refinance until your score improves. You should also calculate your debt-to-income ratio, DTI, and consider paying down some debts, as a lower DTI can help you more easily qualify for your loan. Your DTI is calculated by dividing your monthly debt payments by your gross monthly income. Most lenders prefer to see a DTI of 43% or lower, so use a debt payoff calculator to figure out how much debt you need to pay down to meet this requirement. Finally, make sure you have enough money to comfortably cover closing costs. You can typically expect to pay 3% to 6% of the total loan amount in refinancing closing costs. Some of these include origination fees, appraisal fees, title fees, taxes, and prepaid insurance. You can roll some of these costs into your loan, but that will just increase your overall interest expense. Plus, you'll likely have to put some money down up front to cover other costs. Step 2. Choose your type of refinance. There are several types of refinances, and your goals for refinancing will help you determine which one is best for you. Do you want a lower rate or a new term? If so, a simple rate 10 term refinance might be best. Do you want access to cash? Go for a cash-out refinance. Are you a homeowner who has a low credit score or has difficulty qualifying for a new mortgage? Consider a streamlined refinance. A rate 10 term refinance changes the terms of your mortgage. You can get a longer or shorter repayment term, or change from a 30-year to a 15-year loan, and vice versa. This type of refinance also allows you to switch from an adjustable rate mortgage to a fixed rate mortgage, or vice versa. But if you want to receive cash back at closing, you'll need a cash-out refinance. With this type of refinance, you can borrow up to 80% of your home's equity and get the difference in cash. A streamlined refinance, also called a government refinance, is available to homeowners who have loans backed by the government. So you must have an FHA, VA, or USDA loan to qualify. Typically, these loans have less stringent credit and income requirements than conventional loans. So they're great for borrowers who are having trouble qualifying for a new mortgage. Streamlined refinances also normally don't require an appraisal or private mortgage insurance, so you can save thousands of dollars in closing costs. However, the eligibility requirements are strict, so you won't be able to use this option if you are significantly delinquent on your mortgage or have any recent negative marks on your credit report. Step 3. Pick a refinance lender. You can refinance with the same lender you used for your first mortgage, but you don't have to. In fact, if you want the lowest rates and fees, you should shop around for mortgage refinance lenders and compare at least a few options. The best way to do this is to fill out an application with several lenders and use the loan estimates each one provides to compare them. These forms detail all the fees and long-term costs of the loan and can help you zero in on the best deal. Step 4. Decide whether to lock in your interest rate. Some mortgage lenders give you the option to lock in your mortgage rate, so it does unchanged before closing day. If interest rates are trending upward, you may want to lock in your rate so you don't get stuck with a higher one. If rates are trending downward, you can let your interest rate float in hopes of snagging a better one at closing. Important note, some rate locks may come with a fee, especially if you want to lock in a rate for a long period of time. Step 5. Get an appraisal. Just like when you bought your home, You'll need to get a home appraisal when you refinance to determine the market value of your home. This helps the lender decide how much it can safely loan you. Appraisal fees vary by location, but according to Zillow, you can usually expect to pay around $300 to $700. You may be able to avoid appraisals if you use a streamlined refinance. Step 6. Close on your new mortgage. Once you have gone through all the steps, you get to close on your new mortgage. This will feel similar to when you closed on your original home loan, but may be less exciting since you already have the